Welcome to the Broken Pie Chart Podcast, episode 131. I'm your host, Derek Moore, and this week, finally, after a long absence, is my long-lost, semi-permanent co-host, CEO, and founder of ZEGA Financial, Jay Pestrichelli. Jay, how you doing today?
Good, Derek. Glad to be back. Sorry for my my hiatus.
Yeah, we had a couple people said, is Jay okay? Where is he? I said he's just fine. He just I did some solo episodes. I had couple guests on, but you're back today. So
I'm glad to be back, and of course, you are fine, just fine without me.
All right, so this should be a good episode. I think one of the things, we've been getting a lot of questions from not only advisors, we know their clients are asking, our clients are asking, right? And markets at all-time highs. We have COVID out there, inflation talk, a lot of talk about the Fed. And so this will kind of be, we're going to touch on markets, earnings, inflation, COVID, and we're going to fill in a lot of the blanks here. And some of this will be you and I taking opposite sides on it for the sake of discussion. But let's start with all-time highs. And we know anytime the market's at all-time highs, we always get people that say, is it time to sell? Should I wait? But Jay, and you've covered this before. We've talked. I'll link to another episode. We really just spent the whole episode on this, but I think it's worth repeating your data at all-time highs and what you've been seeing and reading and hearing.
Yeah, and the standard data that we've always shared is that it's not unusual for the market to be at or near all-time highs. 36% of the time, the market is within 3% of an all-time high. So that means, there's a good chance you're close to an all-time high. It's not rare, right? And the challenge that I think people run into is that, we all hear the basics of how to invest in the market, which is buy low, sell high. So why would you buy when it's at an all-time high, right? Because it's the highest it's ever been. But the answer is that's not unusual. It could keep going higher. And this year is a perfect example of how the market could continue to go higher. We hit an all-time high, I think, right after the election in November of 2020, and we haven't looked back. Right? I think the market is probably, as of yesterday, which was Wednesday, the 25th of August, we're probably up 23, 24% from that November high. And so if you had hesitated in entering into the market at that time, you've missed out on large gains. And so we try to tell people, don't worry, markets are by their very nature designed to eventually get back to all-time highs, just for all the dynamics of things like inflation and population growth and the way that the indexes are managed. They generally will push higher. We've talked about that a lot. But this year so far, and we're really, finishing up August here, this is happening on the early side. We've had a lot of record highs this year, Derek, right? I think Wednesday was the 50th all-time high we had in the calendar year of 2021. And, 50 is kind of a random number. But if you look back in history, it has happened. It has happened, I think, 7 other times where a market had 50 plus new all-time highs within a single calendar year. The most recent was 2017, where the market had 62 all-time highs during that year. Market was up, nicely that year. Obviously, that was a year of very, very low volatility. Actually feels very much like that so far this year as well. Correct me if I'm wrong. When did the yield curve flatten? Was that starting to show itself in 2017, the last time it flattened, or maybe that was 19? I could be off by a couple of years on that one. But my point is that this slow and smooth, up and to the right movement on the chart for our market this year, while it is, not uncommon, we are kind of passing this idea that, hey, 50 times in a year is, quite a bit for that to happen. It's only happened 7 other times.
Jay, I think one of the things too is, and by the way, you think about, there is some technical analysis folks that wait for new highs, buy high and sell higher as opposed to buy low and sell high. And I think not always when a market makes new highs or that many new highs doesn't mean the market goes down. I think you've been some of the things you've been seeing, there's some interesting data, right?
Yeah, and when you look at say the next year after these 7 times when the market has made a new high, what has it done the following year? I know that's still months away for us at this point, but the markets typically have they flatten out the following year. There are still some record highs in those years. For example, in 2017, there still were about after 2017 and 2018, there still were about 20 all-time highs after 2017 was over. But some of us may remember the fourth quarter of 2018 was kind of nasty, right? We had a 20% sell off going all the way to to a couple of days after Christmas. In that fourth quarter. So it doesn't, guarantee what the whole year is going to do next, but it also doesn't mean it's over. So, all of those things that we'll say here is that as the market's pressing new highs isn't uncommon. This year's having quite a lot of them. As we pass 50, we're probably going to have a handful more. It probably also means we're going to have a few more all-time highs next year. So what does that mean? I mean, the simple thing is, hey, probably, history tells us that probably there will be higher highs at some point next year, right? So buying today is not absolutely the worst thing. But of course, there's a lot of other factors that we're going to talk about on the podcast here that would that might give you pause about buying at all-time highs. The other thing, Derek, I know you and I talked about it. I don't know if you want to talk about kind of the thing that's driving this, and if you want to run right into earnings here is kind of the surprise that the market is experiencing right now, or did you want to hit on anything else on the all-time high part?
Yeah, as transitioning to earnings, I think it's also worth saying that, I'll link to another podcast where Jay and I discussed ad nauseum. Ad nauseum seems like a bad term. And in a really, we discussed in depth sort of the case for hedging and why you stay hedged. And is why, Jay and I don't try and necessarily predict the markets and time the markets, it's buy and hedge. And so, hey, if the market keeps going up, great, you participate. But if it materially sells off, then okay, you got a floor in there. But yeah, Jay, earnings is, I remember you and I were messaging back and forth. I think it was actually on a Saturday, and might have been March or April of 2020. And all of the earnings estimates were just dire. And, to kind of frame a little bit, the earnings for the S&P were $139.76 in 2020. That's, you think about like a stock of the earnings per share. Well, if you aggregate all the companies together on the S&P and look at their aggregate earnings, you can come up with that. But Jay, I remember you and I were looking at earnings estimates from Goldman, Bank of America, Deutsche Bank, and weren't they like for 21 saying anywhere from 130 to 160 at one point? I feel like it was really low, right?
Yeah, I mean, it was. I don't know if anybody was even projecting to beat the 2019 earnings in 2021, right? 2019, I think, was more like what, 160, 162.
That's right.
And so I don't think very many were even thinking we were going to fully recover in 2021 and even have the earnings level that 2019 experienced, right? So that you're right. The estimates were low, to say the least.
Isn't this, I always say, and we'll get to the bond market inflation in a second. I've got plenty to say on that front, but I always am saying, look, the bond market is sort of telling you the story of inflation. Like the bond market is smarter than the experts. Jay, it's in a weird way. If anybody would have said when the market was at 2,400 back in March of 20, hey, you're going to be at 4,500 in a little under a year and a half, people would have said we were crazy, right? But maybe.
Well, that's the thing, right? And by the way, we were not making that call either, although we did think it was the time to rotate into stocks. But we were not making that call either. This has been, obviously a strong recovery and a strong market, and I think it's fueled by the two things that drive markets, right? Corporate earnings and interest rates, and we're going to talk about both of those things here. But just to maybe round out a little bit about the earnings topic, earnings are used to assess if the market is expensive or not, right? If the price of the market has kind of outpaced what the earnings of the market are. We know this, earnings per share is a very common fundamental data point that is used. That is also applied to the S&P 500 in general as well. Derek, you like talking about earnings on the S&P, so I don't want to steal any fire from you there. But when people were looking at the recovery of the stock market in advance of starting to see the strong earnings that we've actually realized, people thought the market was way ahead of its skis. Even going into the election, I know there's a little pullback going into the election, and then obviously coming out of the election when we hit another all-time high, there was just a lot of feeling that this earnings are never going to be able to keep up with the price of the market. But it turns out so far it's looking pretty strong, right? So I'll pass the rest of that point to you.
So maybe the market was right all along. Maybe people said the market's crazy overvalued. There's no way it should be this high when earnings estimates were lower. And, just to give you a little color on earnings estimates, we've got actual for Q1. We have estimates for the other quarters, but the consensus estimates are, about $201.50 on the S&P in 21, just under 220 in 2022, and 236.60 in 23. I mean, I 23 is sort of new to have estimates, but I mean, like we were talking about, I mean, the market apparently got it right. I don't know, we don't know about the level, but certainly, I mean, those estimates were way low, as it turns out. I mean, earnings have been good. So yeah, I mean, I think it's one of those cases where people have to remember that estimates are estimates, right? Big capital E, it's an estimate, and they get changed all the time. They get revised. These can get revised down. What is interesting, though, Jay, with earnings, of course, the way that you can grow your earnings per share, you can increase revenues, you can increase your margins, you can buy back stock. And by the way, to buy back stock, companies have to have cash. Unfortunately, at the bottom of markets, like in 2008, you would have thought, well, companies would have been buying back their stock hand over fist. They didn't have the cash back then. But Jay, the other thing that's interesting with margins is they've been increasing as well. I mean, that's kind of a strong thing for earnings.
Yeah, I think that's definitely part of it that's pushing it. But we obviously have to come to the equilibrium of the workforce, which is definitely different now than it was in 2019. Whether it's the work from home or people are getting paid to not work yet, all of those things matter when it comes to the margins of a company. But there's also a lot of money out there, which is also helping to push up revenue, right? People will spend if they have money in their pocket. I mean, I'm not making that up. That's not a dig on people in general, but people will. People will have higher confidence. It's why we track things like consumer confidence. My son is taking an economics class, and one of the first things that the teacher asked his class was, "All right, if you had $100 in your hand, what are you going to spend it on?" Right. And almost everybody decided to to spend all of it and whatever they were buying, right? Whatever juniors in high school are buying. I was proud of Xander. He did decide to do a little investing with it, but he spent most of it.
Yeah.
But the point is, as people have, cash in their hands, they're going to spend it. So you've got revenue, which is fine, right? The revenue of companies, people are spending money, and you potentially have a lower margin due to, maybe a more affordable workforce.
Yeah, that's probably a good point. Time to transition to inflation. And Jay, I'm going to flip it. I'm going to let you host this portion of it. I didn't tell you I was going to do that, but you're the host now. What do you want to ask me about inflation and the Fed?
So, Derek, there's been a lot of talk about the difference between transitory and, embedded long-term inflation. Tell me a little bit about, your perspective on, what we're going through now, which is obviously an elevated level. Do you think it's over this year, next year, or do we kind of stay at this, 5% rate for a while?
It's transitory with two big caveats, which I'll explain after I make the first point. There are two types of inflation. There's things that are, and I like to watch what's called the flexible CPI and the sticky CPI. It's just things that prices are more apt to move, and things that aren't more apt to move. A good example of recency that we've seen in the numbers is, of course, rental car prices year over year. We've seen hotel or travel. We've seen food away from home, things that were affected by the shutdowns. Thus far, we haven't seen in the sticky stuff, the more core things, we haven't seen big increases there. We did see that in the late 1970s. So thus far on that front, it's proving to be a little bit transitory. The other thing is Europe is not having the same. I don't want to say explosion in growth of inflation, but they're simply not yet. Now they've had a little bit more of a sustained closure. There's a couple things here though. So I would say thus far it seems like it's transitory, and it also seems like a lot of the price increases go back to the prices of container shipping, Shanghai to LA, Shanghai to Rotterdam, which of course is in the Netherlands. Those recently made another all-time high. It was $1,500 for a container. Now it's over 13,000 in some cases. So the caveat includes the container shipping. The other caveat, though, Jay, and you mentioned it, it gets back to Xander's economics class, and it's supply and demand. And the one of the schools of thought is this was a demand problem, and to help that or to fix that, what do? You do stimulus. You send people checks. And I've heard economists of recent talks say, look, what if this was a supply side thing, and it plays into the container shipping issues and the delay in semiconductors? If it's a supply side shock, throwing money on the fire or gasoline on the fire would be the exact not thing to do, because it would prove to really jump inflation. Those are the two caveats, Jay.
I think the supply side thing is where I was going to, kind of push back on you a little bit. You've obviously touched on it there between the chips and your shipping containers, and even the delay for shipping to get things. I mean, it's just we saw a little bit of that in the lumber market, right? And that has kind of come back to earth. But it feels like if this really is a supply issue, you're right. I like that you said throw money on the fire, because that's all you're really doing.
Right.
is you're just giving people more money to have a higher demand, but you haven't really increased the supply all that much, right? And that's the counterpoint I would bring up, against the transitory, is that how long is transitory, or is it built in and it's just going to cost more to get a dishwasher or to get a refrigerator?
No, I think that's important. The time is what's unknown. I mean, it's much like the markets and interest rates. I mean, in the end, we really don't know. But the one thing I saw some data, and if you looked at savings rates have come back down to more along the long-term trend line. They were much higher, and so that does say that maybe people's available discretionary funds are being drawn down. So maybe that's a situation that would say demand would ease, thus easing the supply side. Although the container shipping thing that's still a mess for sure.
Yeah, no, we I know you always remind us of that kind of fundamental problem in the supply chain with container costs. All right, let me throw another one at you there. So in scenarios where the the inflation stays, right? It sticks a little longer, transitory at this point. I don't think anybody thinks inflation will be done by 2021 yet, but let's say, it sticks a little longer. Why does the Fed decide to move interest rates when there's an inflation risk?
Well, the idea is that if you raise rates, you take away sort of the demand side. The Fed's in a little bit of a box, and people much smarter than me have opined on this. But there's some interesting things that are going on with the Fed right now. Number one is there's such demand for treasuries, so much so that the very short end of the U.S. Treasury, the bill market, went negative for a few days. And what the Fed did was they entered the reverse repo market. I did an episode on that. I'll certainly link to it. But that's basically they exchanged their treasuries on their balance sheet for cash, and, financial institutions that have funds in money markets and banks and such. And they set a floor of 0.05% in the reverse repo market. So in a weird way, they've already tightened. And then the second thing is they could stop the asset purchases. This has a lot of debate. Historically, when they announce they're going to taper, rates spike a little bit, but then they actually go down over time. And I mentioned that demand for treasuries. I'm not sure if that would have as big of an impact or a shock as people think. But Jay, to get back to your question before I threw in all the other things that you didn't ask me about, yeah, I mean, you want to raise rates because you feel like demand is too much, and demand is causing interest rates or inflation to go up. Too many dollars chasing too few goods.
Yeah, would you say it puts a stress on the supply chain, right? As demand is too high?
I think so, but in this case, Jay, I'm not sure that it was all about rates. I think the fiscal policy in this case certainly had a much bigger, effect on things.
Well, I wouldn't disagree with that at all. I wanted to lead you a little bit down the path to, yes, they're going to try to slow demand down by raising rates, but if the supply problem is temporary, then it might be a mistake to slow down demand too much in the first place, right? I think that's probably why they're trying to let this kind of work itself out a little bit and see if the supply chain can catch up, right? Can we get containers back down to heck under 3,000, right? Down from your 15,000. Like will that iron itself out? Do we come to an equilibrium of living with this, all the things that could cause supply problems, right? Whether it's the virus, the additional money that's out in the market. We didn't talk too much about the potential impact of COVID here and what does it mean to live with it going forward. But I think there's probably that argument that I would make. I think you're making on the side that it's transitory. The Fed should probably wait longer rather than act sooner, because if this can work itself out, you don't want to stop the demand. That's pretty strong.
You brought up the lumber market. And I think that's a really good example because number one is I don't believe that lumber mostly comes from Canada, at least to the U.S. And some of the upper Pacific Northwest. I don't pretend to know.
I thought you were going to say lumber comes from trees. No. I was like, yeah, we got that.
Yeah.
Sorry.
But what happened in that market, and it's actually a really good example, is, a lot of the inventory. So imagine you're a business owner, and it doesn't matter. It could be the Gap selling jeans. It could be lumber. But, February, March, April comes, and you're like, man, this is going to be really bad for the next couple of years. I got to get rid of all my inventory. And guess what? The exact opposite happened. People started ordering stuff. It's like what you thought would happen wasn't. So what has to happen? Inventory levels are, I don't have the chart in front of me, but it's like multiple decade lows of how much stuff a store has in the back, in the stock, right? So I think that's another. I'm glad you brought up the lumber market because that is eased now because those mills have come back online and supply has come back and things like that. But I think that's a good point to make, and it goes back to economics 101, right?
Yep. You can fix the supply side, you'll meet the demand side of things, right? And if this is, as you said, a demand driven versus a supply driven, inflation environment, I actually couldn't tell which side of that you were on. I think you were on the demand side as the thing that's causing the temporary inflation rise.
I think it's, but I'm open to the fact that maybe a lot of people have this wrong, and it is a supply side, and inflation is going to be if the government does more and more, stimulus and things like that, that we could get inflation that continues higher. We'll see. I'll let you know in a year or two, Jay. How's that? Fair enough.
I'm sure you won't have to let me know, but I'll be with you. That's good. We'll be watching it together. Very good. How did I do as host? Did I do?
Yeah,
it right
you
for you
did
there?
good. I kind of threw that on you. So let's transition now to. By the way, you brought up a point. So I want to bring something up that a bunch those of us on the investment committee were talking about at ZEGA this morning, and that was Bullard made some comments, and it's worth noting that if anybody isn't up to date on their Fed mechanics, the Fed chair and the New York Fed president. Those are permanent members of the FOMC voting committee, the voting members. And the other Fed presidents, they rotate depending upon the year. So Bullard from the St. Louis Fed, he is not a voting member for 2021, but he actually brought up an interesting thing, which I hadn't heard. Jay, did he express concern about housing prices?
He did. He did. As he was talking about inflation, and I got to tell you, it was the most hawkish comments I've heard out of anybody from the Fed. Not a voting member, we know, but still, he's there, right? He definitely was. He was ready, right? He was out there and saying, "Listen, it's time to start. The tapering and the easing is over." And one of the things he cited was the housing market. So this was the morning of August 25th, August 26th. That's today when we're recording this. But he said there's a problem with the housing market and the boom and how expensive real estate has gotten. And I'm it's the first time I've heard it too, that it's a problem. By the way, I think it's a problem they created, actually.
Well, yeah. Here's some numbers, and this goes to your point, Jay. Guess what? The lower rates are, the more people can afford. How much more? Well, let me just show you something. The median home price in 2000 was 172,900. Median means, you get rid of Bill Gates's mansions, you get rid of, but it's a good. And then the median recently was 374,900. Now that seems like a lot. That's 216.8%. That's over 20 and a half years, right? If I'm doing my math right. So then I looked back and I said, okay, well, mortgage rates, and I think mortgage rates are under 3 for conventional mortgages, but I used a 3.25 mortgage rate on 374,900 is $1,631 a month, principal and interest. And then I went back and I looked and I said, what was the interest rate, the average interest rate? I, of course, searched Google and it says 8.25% with 1 point, which means you pay a point. So anyway, I did 8.
And that was back in
2000.
2000,
yeah. So
right?
8.25% on the 172K and change is 1,300. And so what's interesting is the adjusting for rates, the payment went up 25%. At the same time, housing went up 216% in the same period, just using median to median. Okay. Those statisticians out there might wreck my analysis and say I didn't do it right, but that's the way I did it. So yeah, Jay, keeping rates low and obviously you can afford more house because it's about the payment.
Yeah, it is about the payment. And I don't know if this is a bad thing or a good thing, but when people think about buying a house, it's not, how much of a debt am I willing to carry? It's how much can I afford each month? And when the bank even evaluates your ability to pay your loan, it's, well, what's what's your equity rate, right? Like how much are you going to be able to pay each month? And that's what they decide whether they're going to give you the loan or not how much the size of how large the debt is on the house. And yeah, you're absolutely right. If you could get a bigger house and pay the same amount of money, most people make that decision regardless of the size of the loan that they end up carrying.
Speaking about the size of the house too, and this may be transitory, maybe not. A good example is I talked to a young couple last week, and they were looking at buying their first house. And one of the conditions they had to have, because both of them may have to work from home or are working from home, is they need more space. So initially you say, well, a starter home or a home, maybe you need X number of bedrooms, maybe you need an extra room here or there. But a lot of people now need more space. So that is a factor for sure, I think, in this whole thing.
Absolutely. I think it's part of the exodus out of the larger cities, right? It's why a lot of people are moving out, and probably why, I don't know if that's why they're picking Florida. Maybe there's other reasons, but my state is growing, dramatically just during this COVID period, right? And I think you're right. People need a larger house, Derek, if this whole work at home dynamic is going to go on. And I think a lot of people got really used to it. It will like I said, we have to find our equilibrium. There will be a piece of everybody's work where, working from home a day or two, 4 days, who knows what that number is going to be, is going to matter. And people will want their own office space. You're just not doing it for the kitchen table, once a month now.
Let's transition to COVID. And I'll frame the discussion this way. We think about COVID as the markets and the economy. Neither of us are epidemiologists, although I did watch the show ER when it was on a long time ago, but certainly doesn't qualify us. COVID's interesting, and I think maybe the discussion is, there's obviously the vaccines available now. There are, we hear about the Delta variant, the political side of it, shutdowns, not shutdowns. Australia is shutting down, arresting. Sounds like they're arresting people if they go outside. So, Jay, on COVID, I think the fear isn't as much as it was in March of 20. I think we'd agree on that. But give us your thoughts on this, and I'll chime in.
Yeah, so you're right. Because there's plenty of unknown, but there was even more of an unknown factor in March of 2020. I remember when we wouldn't go to the grocery store, we would have the food delivered, and then we'd spray the bag down with Lysol before we'd even touch it and bring it in the house 4 hours later, right? So you're right, the fear is a little less, but let's keep it with the markets, because I think we all know the human side of this is awful. And there's a lot of, probably a lot of examples we could call out that would cause additional fear. So I'll go back to the two things that I always say drive the markets: corporate earnings and interest rates. We've touched on both of them. And so the things that when I look at the Delta variant, and even if this Lambda variant turns out to be more deadly, the things that I will look at is, will it stop people from generating economic activity? And the answer is probably in the leisure and travel space, but we're all back to work, right? The odds of America, doing mandated shutdowns are very, very low at this point. I know other countries have gone back to that. We have not. I don't think there's an appetite in America for that. So I think from an economic standpoint, with the exception of certain sectors, I don't think you'll see a slowdown in corporate earnings and revenue. When I think about interest rates as the other factor of this, if there is, the Fed decides to keep rates lower for longer because they're concerned about economic activity being lower, which is why they would, again, spur demand and try to create more activity within the economy. I think they probably do not view this as a thing that will slow down economic activity, which means they probably lean towards helping to push rates up a little bit, as they've said. So, I don't think from a market perspective it actually matters all that much, with the exception of a few segments within the economy. And I feel like I'm talking out of the other side of my face with this, because I know a lot of people in the medical space, and I just know somebody that just passed who was vaccinated, right? And they still died from the disease. So, I know that there's plenty of fear out there with this, but when you think about, if you could take that noise out and boil it down to the things that matter to the markets, will it hurt earnings? Will it, change interest rates? I don't think there's any surprises out there with this variant.
I think we have headline risk, and headline risk is one of those interesting things where you remember when Greece was going to default, and that was the headline risk, and CNBC would have a reporter in Greece. Well, that stopped mattering, though the underlying issues still remained. And it's just like oil prices. Sometimes high oil prices or low prices matter. Sometimes they don't. I do think there's headline risk.
But those headlines. So you're right. But those are 1 day moves in the market typically, right? And stuff that we actually like to take advantage of, right? With some of our more active strategies. But you're right. I think headline risk always exists. There's the emotional reaction in the market, but we've seen every COVID fear bought within a day or two. Every COVID scare was bought right up.
Yeah, I think that's a really good point. And plus, the market's at all-time highs at the same time. And you would think, okay, I've been watching, some of the data out of Israel and Iceland. Those are good countries to watch. Gibraltar would be the other one. although it's very small. Hopefully, if we have a Gibraltar listener, send me an email. I'll send you a book. How's that? I want a Gibraltar listener. So we're doing very good in Iceland, apparently, Jay. But back to my point. I mean, these are ones like really high percent that are vaccinated, and a lot of those countries vaccinated with one vaccine, one of the brands, right? And some of the data out of Israel is showing that at least it's been reported that maybe there's some waning effectiveness of them, and the need for another one. We are seeing, at least in the numbers that I read, people who have been vaccinated that are in the hospital. And yet the market's at all-time highs. And I think that sort of supports that maybe the market has digested all of this. The market doesn't like unknowns. Maybe it's now comfortable with the known unknown, if that makes any sense at all.
Yeah, I mean, are you going to cancel your Netflix subscription if we have let's say a lower efficiency rate of efficacy of the vaccines? No. Are you going to change what you're eating? No. Again, you're probably just not going to travel as much, right? But when you think about where you spend your money today, you're going to have the opportunity to continue to spend the money just like you do today.
I think one of the things, I didn't have it necessarily on our core list of topics, but I think it's worth just talking about the wall of worry. And one of the things that's out there right now is Afghanistan. But Jay, you and I both know that we've been in the markets a long time now, which number one means we're getting older. Number two means at least the trade-off is we have a lot of experience. I remember when there was the Russian coup in the 90s, the markets pulled back. North Korea for a while, that was going to cause, obviously, Iraq 1, Iraq 2, 9/11. There's always sort of a wall of worry. Afghanistan is one of those things. I'm not sure that there's been much of a market reaction on that yet. And I'll you said did the preface on COVID. The humanitarian side of this, or any other the politics, we'll leave that for other people to discuss. But I don't think this is a market risk per se.
Nope. I mean, you could probably do 3 degrees of separation so that it could impact the market. I mean, there was headline reaction today, this morning, right? A few bombs went off in Kabul today. So this is Thursday morning I'm talking about. And the market immediately reacted. But it kind of found a bottom and leveled out here. And it's one of those things that you could get headline risk. You're absolutely right. But is it going to affect interest rates? Is it going to affect corporate earnings? If you do have a new terrorist state that has been created there in Afghanistan, then okay, so you want to be in the defense sector because America's probably going to make more bombs and missiles, right? So I don't think. I'm with you, Derek. Even though it's fearful and it seems like a scary scenario, connecting it to the markets it's going to take a couple degrees of connection, right, to get to the point where it would affect things like corporate earnings. 9/11 was one where it was obvious right away how it was going to affect our country, right, and our country's earnings, and I think the market reacted appropriately. But this one, I mean, it's global. It's interesting globally, but I don't think in the near term this has any effect on the markets.
You mentioned travel, and that's a good example. And same thing with 9/11. I mean, I remember being on a plane shortly after that, and I think the plane held, I don't know, 180 people, and there maybe was 19 people on the plane. So that type of thing.
And our life changed,
Yes.
Right? Like think about TSA, like going through security, and the year 2000 was very different than the year 2002.
Yeah, or even remember remember this, Jay, if you didn't have a ticket, you could go to the gate. You had to go through security. Remember that? Yeah. Yeah, no
yeah, sure. Yeah.
Yeah.
See your parents off where they're going. Yeah, sure.
That's right. Now you got to wait outside.
And, listen, I think we probably see a long-term change in the way we live from COVID, right? I'm sorry to get back on that one, but just, some things can have a large impact, a changing impact. Again, that's the whole equilibrium thing I was talking about. But I don't think we're going to have this. I think Afghanistan is interesting, but not market wise.
I want to get back to volatility and rates a little bit. One thing on rates, I do wonder sometimes if, because of the debt held by the public, which is approaching 22 trillion, if there's, I'm not going to say that there's going to be political pressure on the Fed, but I do think it's in the best interest of not only the U.S. government, but a lot of governments around the world for interest rates to be low. I mean, to give you an example, the average annual interest rate paid on Treasuries, of course, when we take on debt as a country, we issue Treasuries. Uh, at 22 trillion at 2%, that's like 440 billion. But on 22 trillion, if let's say rates were to triple, and I'm certainly not saying rates are going to do that, that's what does that go to at 0.06? I got my calculator. That's 1.3 trillion. That's more than the defense budget or Medicaid and Social Security and Medicare, right? So I don't know. It's just something I think to think about. There's definitely an incentive, and if economics, and as your son will find out, incentives matter. So I don't know if you have any comment on that before I transition to volatility, but
Uh, the only other thing I'd say, so yes, of course, we're our government is incented to keep interest rates low, just from a budgetary perspective. I will. So I would agree with you on that. The only other thing I would bring up when it comes to rates with regard to the markets before we talk about volatility is low rates push you into more aggressive assets like stocks, right? When you and I allocate for people and try to build a plan and we have a growth plan for them, building a basket of stocks just really doesn't do it. I'm sorry, a basket of bonds just really doesn't do it anymore. So you're forced into more, growth-oriented asset classes like stocks. And so, we didn't connect those dots for everybody, but the lower rates, tend to kind of push market prices up, which is why I brought up that actually matters to the market. So, sorry, my last point on interest rates was just that.
yeah, and connect another dot on that, and it's sort of obvious. Maybe we missed talking about it. Guess what? Part of people who do intrinsic valuation of companies, of individual companies, and look at future cash flows and decide what a fair value is. I'm talking about the value investors here. Guess what? They discount future cash flows down by some rate of interest, the discount rate, or some other rate. And guess what? Lower rates means future cash flows are worth more. So there's another dot, Jay, that we can connect for sure.
Sure. Are you want to jump to volatility real quick? Yeah.
So volatility, one of the things, I don't have the chart in front of us, but I remember you and I were talking about a graph that we saw. I think this was one of the longest periods, if not the longest, for volatility to come down from a peak back down to its long run average. So we've seen really an extended stretch of volatility. Volatility is, I mean, it went down a little bit, but Jay, it's sort of stayed at the higher end, right?
Yes. Volatility has been definitely, especially considering the lack of any 5% moves and how many brand new all time highs we've experienced this year. The volatility is definitely higher than what historically we would have expected in this kind of environment. Wouldn't you agree?
Yeah, I mean, I think it wasn't shocking or surprising. That's the better word, that it took so long to come down. Because guess what? We're in the middle of COVID and uncertainty and things like that. Um, no, I don't think it's surprising. I think what was surprising, Jay, was back in 2017, right? Was that the year with when the VIX went under 10 at one point? Is it 17? Yeah.
Yep. It was 17.
I mean, basically, everything was ultra cheap when in 2017. But yeah, I mean, I think it's not out of the range from long term, but certainly as sellers of volatility, we've taken advantage of that this run. So for sure.
Yeah, I recently put out a note that I thought probably the low for a little while on the VIX is going to be 15, right? It may touch, it may dip below, but generally speaking, that seems to be the support level, and it's because of some of the things like this unknown out there and the emotional reaction to COVID, the fear of the Fed moving due to higher inflation. I'm going to throw something else out there, and we haven't touched on it, and it's probably it's a new topic. I don't want to open up a can of worms, but the S&P 500 now has a component to it associated with crypto and Bitcoin. When you look at some of the S&P 500 stocks that hold crypto on their balance sheets, it is starting to weave its way in. And so a very smart guy on our investment committee said, as long as, Bitcoin and crypto is as volatile as it is, it's going to be hard to see a VIX below 15 anytime soon. So, maybe that's another one of those outside things to think about here is, what's keeping volatility from going to that, that 13 number, which, by the way, you and I have done studies on to show the statistical relevance of a 13 VIX and what that means and how it truly does show complacency and calm in the market, those kinds of things. But, the odds of us getting there at this point seem low and unlikely.
I'm glad crypto's not a bad thing to bring up. We've done a whole episode on that. Of course, I'll link to that where Jay and I discuss that, position sizing, potentially, percent that you could hold in a portfolio. But no, I think it is. And the thing with crypto is it's been around Bitcoin's been priced for over 10 years, right? But it's only been within the last, I'd say, 5 years. Is that fair enough? That people have been aware of the price. And, look, it's volatile. And I think you bring up a good point. I don't know what that volatility yet translates into, to a VIX handle. I'm not sure yet. But I think, let's say if people are either switching to cryptos or they're leveraged and they've got to sell something and they want to keep, how these pieces all go, people sell what they can sell to fund other things. So I think it's an area to watch for sure. All right, Jay. So I'm glad you were able to make it back on. Hopefully, it won't be another 2 months before you come again. It's by the way, I didn't have you on just so everybody knows, just because a guest canceled. You're not the Tony Randall of.
I wasn't thought, oh shoot, I need somebody to get on the phone.
Right. Yeah, and I think this was a good episode for us to do because people get to hear. This is sort of a conversation that we would have on the investment committee. And while we obviously, we don't make decisions on this stuff. We're hedged or we're buffered and obviously we sell volatility. It's a little inside baseball into some of the things that we talk about. So if people want to follow, Jay mentioned he puts out notes every once in a while and different content. I write a lot of content as well, ZEGAFinancial.com. And you can go to In the News and blog. And that's a good place. You can put your email in. You can sign up and just get notified. Usually about twice a week. So that's a good spot, and to find out more. So Jay, thanks again for coming on today.
Yeah, great to be here, Derek. And maybe next time that we're on, we could play maybe a headline roulette where we could kind of roll, spin the wheel, and whatever the headline is, one of us could challenge the other one to talk about it.
I like it. Let's do that. All right, Jay, have a good one.
Bye-bye.
See you, everyone.